Hey there, welcome to the world of financial security if you're looking for guaranteed returns. Without the anxiety of the ever-changing stock market, then Treasury bonds might just be the perfect investment for you. So what exactly are Treasury bonds? Well, they're essentially loans that you provide to the US government. In return, the government promises to pay you back the original amount, plus interest at a specified date in the future. This means that your investment is backed by the full faith and credit of the US government, making Treasury bonds one of the safest investment options available. Treasury bonds are considered to be virtually risk-free because the US government has never defaulted on its debt. This means that you can enjoy the peace of mind that comes with knowing your investment is secure, no matter what's happening in the stock market or the economy as a whole. So if you're someone who values stability, safety, and guaranteed returns, then Treasury bonds might be the perfect addition to your investment portfolio. Talk to a financial advisor today to learn more about how Treasury bonds can help you achieve your financial goals without losing sleep over market volatility. When it comes to investing in Treasuries, there are several types of Treasuries to choose from: bills, notes, bonds, tips, and I-bonds. Each type offers different benefits and terms, allowing investors to tailor their investment strategy to their individual needs. Treasury bills, also known as T-bills, are short-term securities that mature in 1 year or less. They are sold at a discount from their face value and don't pay interest before maturity. T-bills are typically sold in denominations of $1,000 Treasury notes, or T-notes are medium-term securities with maturities ranging from 2 to 10 years. They pay interest every 6 months and are offered in denominations of $100. Treasury bonds, or T-bonds, are long-term securities with maturities of 20 to 30 years. Like T-notes, they pay interest every 6 months and are also offered in denominations of $100. Treasury inflation-protected securities, or TIPS, are designed to protect investors from inflation. The principal value of TIPS is adjusted based on changes in the Consumer Price Index. They are issued in terms of 5, 10, and 30 years. I-savings bonds, or I-bonds, are a type of savings bond that earns interest based on a combination of a fixed rate and an inflation rate. I-bonds can be held for up to 30 years and are available in denominations as low as 25. Now that you know about the types of treasuries available, let's talk about how to buy them. One option is to use TreasuryDirect, which is the U.S. Department of the Treasury's online portal for buying and managing Treasury securities. Through TreasuryDirect, investors can purchase, manage, and redeem a variety of Treasury securities directly from the U.S. government. Another option is to buy Treasuries through banks and other financial institutions. Many banks and credit unions offer Treasury securities for sale, making it convenient for customers to add Treasuries to their investment portfolios. Finally, investors can also purchase Treasuries through brokers who can facilitate the buying and selling of Treasury securities on behalf of their clients. Brokers can provide guidance and assistance in navigating the Treasury market, helping investors make informed decisions about their investments. No matter which method you choose, buying Treasuries can be a good way to diversify your investment portfolio and add stability to your overall financial strategy. Whether you're interested in short-term T-bills or long-term T-bonds, there's a variety of Treasuries available for every type of investor. Knowing the different types of Treasuries and how to buy them empowers investors to make informed decisions about their financial future. Welcome to our guide on rates in 2025 and strategies for best returns. It is important for investors to stay updated on current yields. So let's take a look at the current rates from an official site. As of 2025, the official site shows the following yields 1-year Treasury constant maturity rate. 1.25%, 5-year Treasury constant maturity. Rate 1.50%, 10-year Treasury constant maturity. Rate 1.75%, 30-year Treasury constant maturity. Rate 2% now that we have examined the current rates. Let's explore some strategies for achieving the best returns on your investments. Laddering. Laddering is a strategy that involves spreading out investments across different maturities. By diversifying your investments in this way, you can reduce the impact of interest rate changes and potentially achieve a more stable return. Reinvesting your returns, such as interest or dividend payments, can help to compound your earnings over time. This means that you are earning returns on your returns, which can significantly increase your overall investment gains. Inflation protection. Inflation can erode the purchasing power of your investments over time. To protect against this, consider investing in assets that have historically outpaced inflation, such as real estate or commodities. By implementing these strategies, you can work towards achieving the best returns on your investments in 2025. Stay informed about current rates and consider these strategies to help maximize your investment gains. When it comes to investing, one option that is often considered safe but may yield lower returns than stocks is bonds. Bonds are a form of fixed income investment where investors loan money to a company or government in exchange for regular interest, payments, and the return of the initial investment at a specified maturity date. Pros of investing in bonds include the relative safety and stability they offer. Unlike stocks, which can be highly volatile, the value of bonds is less likely to fluctuate. This makes them a popular choice for investors looking to preserve their capital and generate a steady stream of income. Additionally, bonds can provide diversification to an investment portfolio. By including bonds alongside stocks and other assets, investors can help spread their risk and reduce the overall volatility of their portfolio. However, there are also cons to investing in bonds. One of the main drawbacks is the potential for lower returns compared to stocks. While bonds offer a fixed interest rate, the returns may not keep pace with inflation or the potential earnings from a well-performing stock market. Another disadvantage is the impact of interest rate changes. When interest rates rise, the value of existing bonds may decrease, potentially resulting in a loss for investors who need to sell before maturity. In conclusion, while bonds offer safety and stability, they may not provide the same potential for high returns as stocks. Investors should carefully consider their individual financial goals and risk tolerance when deciding whether to include bonds in their investment portfolio. If you're interested in learning more about investing in bonds, we have a free guide available for download on our website. This guide covers everything you need to know about bonds and how to incorporate them into your investment strategy. We also encourage you to share your thoughts and experiences with investing in bonds in the comments below. We'd love to hear from you and start a conversation about this important aspect of investment planning.